So it's a nice time we meet for a session of advanced financial reporting. So today we are going to do a question of cash flow that is concerning advanced financial reporting. So in order to understand this advanced financial reporting, you have to understand a question whereby a subsidiary has been disposed or a question whereby a subsidiary has been acquired. So to start with, we will start with a question where a subsidiary has been disposed. So that is a question of December 2017, question 3. And that is the question. So this is the question. So they say that the following are the group statement of comprehensive income and the group statement of financial position of Maneno Group of Companies for the financial years ended 31st October 2016, 31st October 2017. So you are given a statement of comprehensive income, you are given a statement of comprehensive income, then you are given a statement of financial position, that is for 31st October 2016 and 31st October 2017. So for the two periods. Then additional information, during the year ended 31st October 2017, depreciation of 240 million was charged in relation to property, plant and equipment. So an item of property with a carrying value of 885 was disposed of during the year ended 31st October 2017 for shilling 750 million in cash. The loss on disposal is part of cost of sales. Number 3, on 1st August 2017, the group disposed of an 80% owned subsidiary for 1170 in cash. The subsidiary had the following net assets as at the date of disposal. So this one means that as per note 3, you can see that you are told that on 1st August 2017, the group disposed of an 80% owned subsidiary. So this implies that this question is concerning a subsidiary which was disposed. So it was an 80% owned subsidiary. So you can see there you are given the proceeds which they received on disposal, which is 1,170, and you are given the net assets of that subsidiary which was disposed. So the subsidiary had been acquired on 1st November 2012 for a cash payment of 660 million, when its net assets had a fair value of 675 million, and the non-controlling interest had a fair value of shillings 150 million. Number 4, additional property, plant and equipment was acquired by way of lease, amounting to 900 million during the year 31st October 2017. Dividends paid by the holding company during the year 31st October 2017 amounted to 120 million. The rand was revalued upwards by the holding company by shilling 60 million during the year ended 31st October 2017. So they require you to do the group statement of cash flow in accordance with the International Accounting Standard 7 statement of cash flow for the end at 31st October 2017. So without wastage of time, you just go direct to the question and you write the heading. So you say it's a question for Maneno. So it's Maneno Group. So we say consolidated cash flow statement. Consolidated cash flow statement. So it's a consolidated cash flow statement. So for the year ended, so it was for which period? Our financial year was ending on, we can confirm this. So our financial year was ending on, so you can see you are told the income statement is as at 31st October 2017. So you write there 31st October 2017. 31st October 2017. So after doing that, remember that the examiner never specified which method we are supposed to use. So for this question, I will use both methods. I will start with indirect method, then I will move to direct method. So talk about shillings there. So you start with, so I'm starting with indirect method, of which under indirect method, obviously we have to start from operating activities. So under operating activities, you always start from profit before tax. So profit before tax was, so profit before tax is here. You go to your income statement. This one, 699. So you can see the 699 there. So this is the 699. So profit before tax. So we need to adjust that. So 699. So you adjust with what? So this one is adjusted with non-operating items. So which are these non-operating items? So you say adjust for. So the non-operating items are things like depreciation, impairment, we have loss on disposal, and we have gain on disposal. So on this scenario, so depreciation, you will find that in a question, in some question you have been given, in some questions it's not provided. So without forgetting, we can have amortization. Without forgetting amortization. So on this scenario, we have to check for depreciation. So in some questions you would be given, in some questions you will not be given. So in questions whereby you are not given depreciation, you have to open a depreciation account. But on this scenario, you were given depreciation, not one. During the year ended 31st October 2017, depreciation of 240 was charged to property, plant, and equipment. To property, plant, and equipment. So that is 240. So that is the 240. So remember that I'm now adjusting my profit before tax. So if in order now to arrive this at profit before tax, remember things like depreciation was subtracted, and this depreciation is an operating items. So we add back. So what about impairment? So what is an impairment, Janet? What is an impairment? So impairment is loss in value of goodwill. So when goodwill loses value, we say that it has been impaired. But remember, in cash flow statements, what we always do is just a comparative analysis. So in order to conclude that there is this element of impairment, we have to go to our non-current assets and check if there was goodwill. So go to your non-current assets and check if there is goodwill. So this one means that if you go to your non-current asset under this balance sheet, there is this goodwill. So at the start of the year, goodwill was 390. So at the start, I mean 2016, because this is the end of 2016, which is the opening of this year, which is ending 31st October 2017. So 2016 is at the start of the year, for the year ending 31st October 2017. Because obvious, after 31st October 2016, we moved to 1st November 2016, which is the start of the year which is ending 31st October 2017. So that's why I'm saying for the transactions of 2016 will be my balances brought down. So I would be checking balance brought down. I consider some transactions which took place during the year. Then I will compare with the balance carried down. That is for 2017. So on this scenario, there was 390, this goodwill as given in the non-current assets. Then there's 255 at the end. But before I conclude that there is impairment, we have to check the goodwill of this subsidiary, which is under Note 3. So Note 3, you are told, on 1st August 2017, the goodwill disposed of, not the goodwill, the group disposed of an 80% owned subsidiary. Remember that you cannot dispose, the group could have not disposed something it doesn't own. So this means that this 80% disposed subsidiary, it was acquired some time back. That is why if you move to this statement down here, you are told that the subsidiary had been acquired 1st November 2012 for a cash payment of 660 million, when its net assets had a fair value of 675 million, and the non-controlling interest had a fair value of 150 million. What does this imply? So when on this scenario, we have to compute the goodwill of this subsidiary, which was disposed. And when you compute this goodwill, even if it was disposed on August, as told in Note 3, 2017, we have to compute as at the time it was acquired. That is why you can see down there, you are told that the subsidiary had been acquired 1st November 2012. So before I conclude that there is an impairment with the information we have from the trial, from the balance sheet concerning goodwill, what you do is you have to compute first the goodwill of this disposed subsidiary, but you compute the goodwill of that disposed subsidiary as at the time it was acquired. And you need to know that goodwill is equals to what? So goodwill is equals to purchase consideration. So you talk about purchase consideration, you minus share of net assets acquired. You talk about purchase consideration minus share of net assets acquired. So on this scenario, you have either, when computing goodwill, you have either two methods to use. You have to identify which method to use. You can either go for full method, or you can either go for partial. You can either go for full method, or you can either go for partial method. So in order to use full method, this one, you must be given the fair value of the non-controlling interest. You must be provided with the fair value of NCI. So which means that in order to use the full method, the NCI must be measured at its fair value. In order to use the full method, the NCI must be measured at its fair value. Then for you to go for partial method, you will not find anything concerning fair value of NCI. So on our question, the subsidiary which was disposed, the information given as at the time of acquisition, did they provide? Yes. So if you can see this statement, they said the subsidiary had been acquired on 1st November 2012 for a cash payment of 660 million, when the net assets had a fair value of 675 million, and the non-controlling interest had a fair value of 150. So this is what qualifies for us to go for the full method. The non-controlling interest, this one, the non-controlling interest had a fair value of 150. So it means that the fair value of the NCI, non-controlling interest, has been provided, which means that we use full method, of which under that full method, the goodwill which will arise will be attributable to the parent. The goodwill arising will be attributable to the parent and that non-controlling interest. So since I've said that we start with purchase consideration, and they said that when this subsidiary was acquired, according to Note 3, when this subsidiary was acquired, they paid a cash of 660 So the subsidiary had been acquired 1st November 2012 for a cash payment of 660. That is a purchase consideration. So for this method to be full, I said we must be given the fair value of NCI. We must be provided with the fair value of non-controlling interest, which they provided. They provided that. They said, again in note 3, there are sentence of my sentence down here. They said non-controlling interest had a fair value of 150. 150. So that is the 150. Then we subtract share of net assets. Rest share of net assets. Share of net assets. So the share of net assets. So the share of net assets on this scenario, as at the time of acquisition, again, I am sure that they gave us the net assets. They said the subsidiary had been acquired. I'm again under the sentence, which is down here in note 3. But this one, the subsidiary had been acquired on 1st November 2012 for a cash payment of 660 million when it's net assets. Net assets, so that is what we were looking for. Net assets, remember this is the total value of the equity items. So the net assets had a fair value of 675. 675. Of which you know that this was an 80% owned subsidiary as told above there. So this one, they say that on 1st August, the group disposed an 80% owned subsidiary. So its net assets as at the time of acquisition is 675. 675. So I will say 80% of 675. Then again, I will say 20% of 675. So what are you getting? 80% of that. So what I'm getting here, 80% of 675, that is 8% of 675. So I'm getting 540. So this is 540. Then the other one, 20% of 675, I'm getting 135. I'm getting 135. So if I subtract, so remember the 20% is the non-controlling interest. Never wonder where 20% is coming from. Remember that this subsidiary was an 80% controlled subsidiary. So the percentage which is unacquired in the subsidiary is what we call minority shareholders, or we call them the non-controlling interest. So that is what I'm saying. The 20% is for the minority shareholders. And when we know that the full method is a goodwill attributable to parent and those minority shareholders, the NCIs, we call them the noisemakers in the organizations. So 660 minus 540. So this is 120. Then 150 minus 135. That is 15. Eh? So that this is my goodwill. So if you add total goodwill, so total goodwill here is 135. So what I will do, in order now to conclude, that remember that we were looking for impairment. So that is why it necessitated me to go and look for goodwill of the disposed subsidiary before I do my analysis. So I said, in order for you to have impairment, first you must be given goodwill under the non-current assets. So if you go to your non-current assets, by the start of the year, which I said the end of 2016, those are the balances for the start of the year, which is ending 31st October 2017. So if you go to your non-current assets, you can see by the start of this period, the goodwill was 390. Then at the end, it was 255, 390, 255. So what I will do, I will say 390. So balance pro down of this goodwill was 390. This one is 390. So I have to subtract on disposal. So on disposal of subsidiary, it was 135. on disposal of subsidiary. Remember that on the disposed subsidiary, it was having a goodwill of 135. So if I take 390 minus 135, so I'm getting 255, 255, 55. And our balance carried down was, so I'm getting here 255. So, and our balance carried down, remember it was 255. So there is no goodwill. So this is 0. There is no impairment. Sorry, not goodwill. There is no impairment. So if it could have reduced a bit, let's say if my balance by this time could have been even 300, then the other one is 255. By the end of that period, I could have said there's a 45 figure for impairment. But now, after adjustments, the value we have and the value at the end is the same. So which means that there is no impairment. There is no impairment. But for you to do all of these calculations we have been doing first, what guides us is all about, I've said, you must go to your statement of financial position to check if first there is under non-current assets, there is goodwill. Then after that, you check loss or gain on disposal. Was there an asset which was disposed or was acquired? So we check under the additional information. So under the additional information, under this additional information, note 2, we are told an item of property with a carrying value of 885 was disposed of during the year ended 31st October 2017 for 750. So which means that there was a loss of, so 885, then it was disposed as 750. So there's a loss of 135. There's a loss of 135. So the difference. So you take the difference. So 885 minus 750. So after that, so remember that even the loss on disposal is an expense. So in order to arrive at profit before tax, it could have been subtracted. So that is why now to adjust, I'm adding back. Is there a gain? There is no gain because there was no another item which was disposed. Then amortization, there is no amortization. Why? Because if I go to my non-current assets, I can't see if there is another intangible asset. So the only intangible asset which was there is goodwill. The only intangible asset which was here is goodwill. So there is no another intangible asset like patents or trademarks, so that we can start checking for its amortization. So since it was in goodwill, we checked for impairment, of which we arrived at our conclusion that there is no impairment. So that is fine. So after you are done with those 5 items, you have adjusted your profit before tax, you go back to your income statement. You go back to your income statement. So under this income statement, what you do, there is again some items you need to adjust here. Remember that our profit before tax is 669 here. So go back once. So you can see there's finance cost, there's admin, distribution cost, we have share of profit after tax in associate, gain on sale of subsidiary, there is cost of sales and revenue. So here the correct operating activities, which we cannot adjust in any way here, the correct ones are revenue, cost of sales, distribution cost, and admin, the administrative. So therefore, revenue, other than that is revenue, cost of sales, distribution cost, and administrative expense. Another item which is above this profit before tax, adjust against the profit before tax. Right now, 450, this 450, the finance cost, this one was subtracted, you add. There's this share or profit after tax in associate. It was added, you subtract. There is this gain on sale of subsidiary. The 120, it was added, you subtract. So let us start with that. Gain on sale of subsidiary. Gain on sale of subsidiary. So it was 120. So which we say we subtract. Then another item I've said is concerning, the other items I've mentioned is concerning what? Share or profit after tax in associate. The second item there, share or profit after tax in an associate. So the share of profit after tax in associate, it was 144. Again, we subtract share profit after tax in associate. So I said other than revenue, cost of sales, administrative cost, and the selling and distribution. So another one is finance cost down here, 450. So that one was subtracted. I would add. So that one I will add. So up to that point, we have a cash flow before working capital changes. Cash flow before working capital changes. So cash flow before working capital changes. So I will take 699, 699, not 669, 699 plus 240 plus 135 minus 120 minus 144 plus 450. So I'm getting 1260. Then after this, we talk about working capital changes. So the working capital changes items. So under these working capital changes, we talk about current assets and current liabilities. So the increase or decrease, that is current assets or current liabilities. Like under current assets, we talk about inventory and trade receivables. Maybe again, if there would be some prepayment. Then under current liabilities, we talk about trade payables and some accruals. So which means that if I move to my current assets, I can check an increase. Remember that we are checking increase or decrease in those current assets, of which I've said inventory and trade receivables. So in this scenario, we have inventory of at the start 2016 3090. So 3090. If I input in my cal, they never forget to consider the value of inventory for the subsidiary which was disposed, not the 3. Remember that this subsidiary which was disposed, it was having an inventory of 90. So after you have taken your balance pro down, sorry for this, I moved it to another question. So after you have taken your bro down for this inventory of 3090, I have to subtract the 90. Remember that because it was a disposal, the subsidiary was disposed. So I get 3,000. Then I compare with the balance carried down, the 3,900, this inventory. So I can conclude that it increased by 900. There was an increase in inventory by 900. There was an increase by 900. Because after getting my answer, I take 39 minus the answer. So I'm getting 900. So I will say increase in inventory. So increase in inventory 900. So increase in assets, you subtract. Why? Because there's a cash outflow. Your stock has increased. Your stock has increased. So after that, we talk about, so the stock has increased whereby you are paid cash. So there's a cash outflow. The second is there's a trade receivable. There's this trade receivable by the start, that is 2016, it was 3120. Then after that, we subtract for the year. So we take 3120 minus the one which was there, not for the year, but the one which was there under the subsidiary which was disposed, not the 3. So there was a receivable of 135. So we subtract that. So 135. So if I subtract that, you can see I'm getting 2985 on my calculator. Then I compare with the balance at the end. So the balance at the end, this is the 135. So you can see the receivable, 2017. So there's this 135. So you can see it increased. So it increased. So it increased from the 2985 to 3120. So that is 135 anyway. So there's an increase by 135. So there's an increase by 135. So after that, we talk about another item which is there. So if there was prepayment, not another item, but if there's prepayment, so under these current assets, the only thing which is remaining financial asset at fair value and the cash and the bank balance. So financial asset at fair value and the cash and bank balances, those are cash and cash equivalent items. So we call them cash and cash equivalent items, including bank overdrafts. So cash and cash equivalent items, we call them financial asset at fair value. That is one example. Also, we call it short-term investments. We have cash and bank balance, and also we have bank overdraft. But that one, maybe it would be under the current liabilities. So under the current liabilities, the only thing I will check here is either there is trade payable. So there is a trade payable. At the start, it was 1785. So it was 1785. So I have to subtract. So you are seeing this 1785. So I have to subtract the one for the subsidiary which was disposed, not the 3, 540. So there's this element of 540. There's this element of 540. So I have to subtract that. So I have to minus 540. So I'm getting 1245. So after getting 1245, I will compare with my balance carried down. So my balance carried down for trade payables, that is at 2017, it was 2955. It was 2955. So it means that there was an increase in payables. Your creditors increased. So it increased by what value? So because it increased to 2955. So 2955 minus answer. So there's a 1710. So I'll say increase in payables. So remember that your creditors, yes, they have increased, which means that have you paid them anything? So there's no cash outflow because creditors are these personnel who sell to you on credit. So if they could have reduced, this when we say that we have paid them, we subtract. But if they are increasing, it means that they are continuing supplying without being receiving anything. So they have not received any money. So there is no any cash going out by this time. There is no cash going out. So those are the three items. So you minus. So you do the relevant summing up from the 1260. So I take 1260 minus 900 minus 135 plus 1710. So 1260 minus 900 minus 135 plus 1710. So I'm getting 1935. I'm getting the 1935. So 1935, we call it cash generated from operations. So cash generated from operations. So that is 1935. So after that, we raise tax paid. So we have to determine tax. So we have to determine tax. So in order to determine the tax, so tax paid, so taxation, how to determine tax. So these are working. So working under this tax, you consider deferred tax. And we have to consider the current tax. We have to consider deferred tax and current tax. So deferred tax and the current tax. So we start from the balance brought down. Balance brought down. So the balance brought down, you go to your non-current liabilities and current liabilities. So under the non-current, I can see my deferred tax is there. At the start is 915, that is as of 2016. What about current? Current is 63. 63. So 915 plus 63. So 915 plus 63. So 915 plus 63, what is the total value there? So that is 978. 78. Then what I will do, I have to add income tax for the year. From P&L. So income tax for the year from P&L. So from the P&L, we go to the income statement. We go to the income statement. So under income statement, the income tax from P&L is 144. This one, the tax they paid during the year from the income statement, income tax, 144. Then after that, we have to raise the income tax, the tax from the disposed subsidiary. From the disposed subsidiary. So that is income tax, not income, but income tax. So the income tax for the disposed subsidiary, if we check, you can see there is a figure there. So for the disposed subsidiary, so note 3, there is a current tax of 15. You can see there is a current tax of 15. So that is for the disposed subsidiary. So you consider that 15. So which means that that one we raise. So we say 978 plus 144 minus 15. So this is 1107. Then we consider balance carried down. We consider with balance carried down. So balance carried down is again for both deferred tax and the deferred tax, and the current tax. For deferred tax, I can see here we have 1020 under non-current liabilities. Then we have the 84 under current. So 1020 plus 84. 1020 plus 84. So 1020 plus 84. So you can see we have 1104. So these figures are coming from this calculator. So that is the calculator which is producing those figures. So remember that after making adjustment, our tax was 1104. By the end is 11. So after making adjustment, it was 1107. So 1107. But by the end, it was supposed to be 1004. So which means that they paid a tax of, because it reduced, they paid a tax of 3. They paid a tax of 3. The difference, they paid a tax of 3. So which means that here, we have to raise 3. We have to minus the 3. So that we get a cash flow. We get a cash flow from operating activities. So the cash flow from operating activities, anyway, you will know that cash flow from operating activities will be 1932. So this one will be my A, 1932. So after we are done with operating activities, the next part we are supposed to move to is called investing activities. So we call it the investing activities. So under investing activities, we talk about some few items there. Like now, cash received on disposal of an asset. So cash received. So we talk about cash received on sale, on disposal. So cash received on disposal. On disposal. So I have repeated there. So there is a on disposal. So on disposal of assets. So if you go to additional information, you can see that there was a cash received on disposal of a certain asset there. So additional information number 2, an item of property with a carrying value of 885 was disposed of during the year for 750. So the 750 is what they received. Then the next thing we talk about is cash paid. Because already there was no another asset which was disposed other than the subsidiary. That one I will record later. So now we talk about cash paid on acquisition of asset. So on acquisition of asset. So to get this, you have to do what we call PPA analysis. So we have to talk about balance brought down. So balance brought down, we go back to our balance sheet. So the balance brought down for the PPE, property, plant and equipment. So property, plant and equipment, this is 13,500. 13,500. So that is 13,500. So after that, we talk of now from note 1 to the last one. We check anything which is affecting our property, plant and equipment. Remember that property, plant and equipment is all about all tangible assets which have been aggregated. So I will check anything affecting my tangible assets. So tangible long-term assets, so anything affecting that. Like now, note 1, there was a depreciation. Depreciation obviously is a tangible long-term asset which depreciates. So there's this element of depreciation of 240. You subtract that. Note 2. So the next additional information, note 2. There's this element of property which was disposed again. Its net book value was 885. So they call it a carrying value, 885. So on disposal, so I'm picking 885, which is the carrying value. Because the value I started with here is a net book value for this relevant property, plant, and equipment. That is why I've picked 855. It's 855 over 885. It was 885. So let me confirm that. So it is 885. The carrying value of this asset which was disposed in note 2. So it is 885. So after that, we talk of another item. We move to note what? Note 3. Note 3, there was a subsidiary which was disposed. This subsidiary again was having a property, plant, and equipment of 2025. This one, 2025. This one was disposed. So this subsidiary was having a property, plant, and equipment of 2025. On subsidiary disposed. So talk about 2025. Another thing, after that, we move to note 4. Note 4, there was a property, plant, and equipment which was acquired by way of lease. So the one of 900, so that is acquisition. PPA acquired. So it was 900, so that one you add. Then another thing, the last additional informations. Number 5, it was dividends paid by the holding company, so that one can never affect your property, plant, and equipment. The last one on 6, there was rand which was revalued by this 60. They have been given, it is provided there, 60. So rand revalued. So there was an element of 60. So up to that point, what are you getting? So if I take 13,500 minus 240 minus 885 minus 2025 plus 900 plus 60. So I'm getting 11,310. I'm getting 11,310. That is 11,310. So then we compare with the property, plant, and equipment by the end of the period there. So by the end of the period, it was this 18,000. So balance carried down is 18,000. So which means that there was an increase by So there was an increase. So I was saying that. So after brought down, you pick another items which are under the additional information, which can affect your property, plant, and equipment. And you know that the property, plant, and equipment is all about tangible long-term assets which have been aggregated. So after adjusting all of them, you get 11,310. So, but the balance carried down is 18,000. So which means that it increased by 6690. So after increasing, so we can say this was an acquisition. So if it could have been reduced, we say there was a disposal. So which means that this one implies that they paid cash of 6690. Cash paid of 6690 to acquire the asset. So another item which was maybe acquired or disposed. So there was no another item. So after that, we move to the next working, whereby I have to check for dividend received. So dividend received from, so it can be received either from an associate or from a joint venture. So how can you determine it's an associate or it's a joint venture? So you go to your non-current assets and check if there's an investment in associate or investment in joint venture. So you can see under your non-current assets, there's an investment in associate. Investment in associate. So which means that there is a dividend received from associate. So in order to do this, I don't have to do huge working. It's very simple to determine this, because what I will do, so in order to determine this, so that is a dividend received from associate, I will go to the question, I will go to the point of investment in associates under non-current assets. This investment in associate. So at the start is 420. So I will input 420 in my calculator. So 420, I will add, so 420 at the start, this 420. I will add what they received. Remember, they invested in associate. An associate is an investing company which is acquired, and its percentage of acquisition lies between the percentage of 20 to 49. Associates are accounted for using equity method. So in order to get this, they use the equity method. But that one I will cover it under consolidation. In consolidation, I will compute, and you will know how they arrived at investment in associates. But on this scenario, I'm doing just an analysis. So after taking my 420, I will add what they received during the year from that associate as an income. So you can see under this, there is this share of profit after tax in associate. So after an associate paid its tax, Maneno, which is the parent, requested for an income of 144. So we have to add. So you take 420 plus 144 plus 44, 144. So then the balance carried down is 510. The balance carried down is 510. So after I've taken 420 plus 144, I'm getting 564. But the balance at the end is 510. So you can see it reduced. Instead of being 564, it's 510. So which means that they received a dividend of 54. I will write here and say 420 plus 144 minus 510, 510. So that is 54. So after that, we finish with what they received on the subsidiary which was disposed. So cash received on disposal of subsidiary. On disposal of subsidiary. So cash received on disposal of subsidiary net of cash disposed. So when they disposed this, I remember they got 11, it was 11 what? So let's check. So let us avoid the speculation and check. So it's 1170, it's there, not the 3. On 1st August 2017, the group disposed of an 80% owned subsidiary for 1170. But remember that when it was disposing this, it was having a cash and a bank balance of 105. This one, you have to subtract that. That's why I've said net of cash disposed. So there was a cash and bank balance of 105. So 1170 minus 105. 1170 minus 105. So this is 1170, not 1117. So this is 1170. So 1170 minus 105. So there's 1065. So up to that point, I will take 750 minus 6690 plus 54 plus 1065. So I'm getting a cash out from 4821. So that is a cash flow from investing activities. So let us finish with financing. So under financing activities, we talk about equity part of this balance sheet. So the equity component, so of which, and also we talk of some non-current liabilities and current. So on this scenario, I will start with ordinary share capital. So under ordinary share capital, I will combine with share premium. I will combine with a share premium. So I will combine with the two. So I will combine the two, not with the two. I will combine the two. So ordinary share capital and share premium. So ordinary share capital and share premium. Some equity components. So let's start with ordinary share capital and share premium. So we check that from our question. So from our question, the equity part, so I'm talking about this. So I will start from equity and liabilities, ordinary share capital and share premium. So this is 4,500 plus 0. So that is 4,500. So balance brought down anyway. So I talk about 4,500 plus the 0. So that is 45. Then we will talk about issue of shares as purchase consideration. So there was no issue of shares as part of purchase consideration. So remember the subsidiary which was there, it was disposed. It was not even acquired. So you will find in some question they acquired a subsidiary and they paid their purchase consideration in terms of shares. Then if there's a bonus issue also you put here. So up to that point I have 4,500. I will compare with my balance carried down. So balance carried down on this scenario is concerning so I would take ordinary share capital of 6,000 and share premium of 900. So these, so the two. So the 6,000 plus 900. So that is 69. So you can see that it reduced or it increased. It increased from 45 to 69. So the amount has increased. So which means that in order for the value to increase, the issued shares, issue of shares. So it was through issue of shares. That is why the value increased. So 69 minus 45. So this is 24. So that is all about 24. So I will say here, cash received. So they received the cash when they issued shares. Cash received on issue of shares. So the 2400. The 2400. So after that, we have to move systematically. So after ordinary share capital and share premium, there is this revaluation reserve. That one we don't have to deal with that. Then there is retained profit. So this retained profit, we could have used it to determine dividends paid by the parent, but for the better, this examiner provided that. He said note 5, dividends paid by holding company. Holding company is like the parent company. During the year ended 31st October amounted to 120, so it paid. So that one is given. So if it could have not been provided, we could have computed using the retained profit. So for now, I will record dividend paid by parent. So the 120, dividend paid by the parent of 120. So after that, we have to talk about the next thing in our balance sheet. The next item in this balance sheet. The next item in this balance sheet is concerning, remember that after retained profit, there is a shareholders fund attributable to parents. That is the total of this equity part. Then there is this shareholders fund attributable to non-controlling interest. So that one, the shareholders fund attributable to non-controlling interest, we have to determine the dividends paid out of that. We have to determine dividends paid out of that. So we have to determine dividends paid out of that. So we talk about dividends. So dividends paid by NCI. So I will pick the balance brought down. So balance brought down for the NCI. Balance brought down for the NCI. So the balance brought down here for the non-controlling interest is this 525. So the 525. So that is the one I've picked there. So the 525. After that, I need to check what is the profit for the year to the NCI, to the non-controlling interest from the income statement. So you can see the total profit was 615, but there is the one which is attributable to parent of 540 and the non-controlling interest of 75. So that is the one we record, 75. Profit for the year. For the year to NCI. So the 75. So after that, we have to consider the NCI, not the NCI, yes. The NCI on the net assets, on the net assets of disposed subsidiary, subsidiary. NCI on the net assets of disposed subsidiary. So in that scenario, we will take the net assets of disposed subsidiary. The total net assets of disposed subsidiary, according to note 3, according to this note 3, it was 1,200. You can see the total here is 1,200. The PPE, inventory, receivable, cash, and bank balance, trade payables, current tax, and bank loan. It's giving us a total of 1,200. So multiply that with 20% because it was an 80% on the subsidiary. So it means that the non-controlling interest is 20%. So 20% of the 1200. So if I take 0.2 times 1200, that is 240. So remember that this one I have to raise because it was undisposed. Then after this, I have to raise the NCI goodwill for the disposed. For the disposed subsidiary. So that one we did, and we got 15. So for you to determine that, you have to use full method. That is why we use the full method. We got the goodwill of the NCI 15, and that of the parent was 120. So I have to record here 15. So I'm minusing because it was disposal. So 525 plus 75 minus 240 minus 15. So I'm getting 345. Then balance carried down for the NCI, that is non-controlling interest. Profit attributable to this NCI under the balance sheet. Is all about 225. It's all about 225. So you record that. So it means that it reduced. So since it reduced, there was dividends paid. So the dividends paid is 345 minus 225. So this is 120. So there's a dividends paid of 120. So dividends paid by NCI. That is non-controlling interest. The 120. So after that, we move to the next part. So next part of this question is concerning after the NCI, we move to bank loan. So bank loan, I can be able to see that by the start of this period, it was 3K, that is 3,000. Was the disposed subsidiary having any bank loan? So 3,000, there is this bank loan of 600 for the disposed subsidiary, we minus, so we have 2,400. Then we compare with 420. So which means that again, it increased. So which means that there was acquisition. Because after taking 3,000 minus 600 for the disposed subsidiary, we get to 2,400. But at the end here, you can see the bank loan is 4,200. So which means that it increased by 1,800. That it means that they acquired another bank loan. So acquisition of bank loan. So we have an acquisition of bank loan. So I will take it was 3,000. So minus the 600 on disposed subsidiary, we compare with 42. So we got 1,800. So that is another loan which they acquired, which means there was money in. So after that, we move to another thing. So another thing here, after we are done with bank loan, there is this obligation under finance risk. So there is this one for non-current liability, and you can see there's another one down there under the current liability, obligation under finance risk. So we have to combine the two. Then we have again to check anything which was affecting that risk. Like now in note what? Note 5, note 4, not note 5. Note 4, there was a plant which was acquired by way of risk. So also we have to incorporate that. we have to incorporate that element of a plant which was acquired. So we talk about obligation under finance risk. So I have to combine both for the current liabilities and the long term. So balance brought down. So balance brought down under the non-current liabilities. So under the non-current liabilities, I have 135. Then under the current, I have 30. So that is 165. So 135 plus 30. So that is the 165. After that, I have to add the one which is under note 4. PPE acquired by way of risk. The one for 900. So I get here 1065. Then I will compare with balance carried down. So balance carried down. So balance carried down for the risk. So the two of them. So the 630 plus 45. So the 630 plus 45. So 630 plus 45. So that one is 675. So you can see it has reduced from 1065 to 675. So after we made some adjustments. So which means that if it reduced, they made a payment. So risk repayment. So they paid how much? 1065 minus 675. So they paid 390. They paid 390. So I will say risk repayment. So 390. So after that, I have to check if there is anything else. Mostly the main thing which would be remaining is maybe interest. So because here I can see deferred tax, that one we are done with that. Because we subtracted that under operating activities, we combined with current tax. So the only thing which is remaining is interest. So there's an accrued interest here, which we need to incorporate. So we need to determine interest paid. So for the accrued balance brought down. So for the accrued interest, balance brought down is so balance brought down. So it's this 27. Then after that 27, I need to add with the one for the year, the finance cost, which is 450. This one, which is given under the income statement. So 27 plus, so you say 27 plus the 450, which is the finance cost for the year. Finance cost for the year. Then I will compare with balance carried down, this 21 at the end of the year. That is by the end of 2017. So the two, then I will compare with balance carried down of 21. So 27 plus 450, I'm getting 477. Then now it reduced to 21. So which means that they paid an interest of, so interest paid, so it reduced by 456. So which means that they paid 456. So we record here interest paid. That one we subtract. So you take 24, there's nothing else. 2400 minus 120 minus 120 plus 1800 minus 390 minus 456. So I'm getting 3114. 14. So after the 3114, I have to get net cash flow. Remember that for you to get the net cash flow, you have to start the one you got under operating. So operating, we got 1932. So we got 1932. I have to minus the 4821, this one. Then I have to add 3114. So the one for financing. So 1932 minus 4821 plus 1314. So I'm getting 225. 25. Then here I need to do cash and cash equivalent are working. So cash and cash equivalent. So I have to talk about, we said we have various cash and cash equivalent items, of which in this question there were 2, if not the 3. So there was a financial asset at fair value. You go to your current assets. So there's financial asset at fair value and cash and bank balance. Cash and bank balance. So we have, so remember that this is 2017, this is 2016. So we have financial asset at fair value. So we have the financial asset, which is, so the figures there. So we have a figure of 135 and 130, that is 135 and 30. So 135 and we have 30. Then cash balances. So the cash balances, this is, so we have cash and bank balance is 510 and 390. 510 and 390. So that is fine. So there was no bank overdraft. So if you can check on your current liabilities, there was none. So if there was an overdraft, you subtract. But there was no overdraft. So by this period, we have 30 plus 390 for 20. Then 135 plus 510, 645. So which means that my cash and cash equivalent at the start of the year is 420. My cash and cash equivalent at the end of the year is 645. So if I will come here and say, add cash and cash equivalent, balance brought down. So the 420. So I'm supposed to get cash and cash equivalent balance carried down. So I'm supposed to get cash and cash equivalent carried down of 645. So the one we got down here, 645. 645. So, and that is the end of this question using the indirect method. That is the end of the question using the indirect method. So when we meet next time, we will be able to do another question of acquisition of a subsidiary. So I think you have the concept whereby a subsidiary has been disposed. Thank you. So that was the end for today's class. Guys, remember that class numbers postponed their exams to May 17. So never fail to continue revising. So continue revising, use my videos very well, share with other students to gain, and never forget to give me a subscription so that you can be able to grow this online school. So let us meet next time when I will be doing another question for cash flow, whereby a subsidiary has been acquired, and you will be able to get the concept very right. So that is a question, I think, for 2016. It's very wide and a very in-depth question. So all the best in all your preparations for the coming exam.